Hi everyone, I'm Jamie Goh from 𝐤𝐵𝐿. In my previous videos, I've shared that interest rates don't move randomly, they move based on macro conditions. And today, we are entering a phase where rates are stabilizing and gradually easing. So when you look at this whole movement, you start to realize something. Interest rates don't move based on opinion, they move based on macro events. And instead of trying to predict where rates will go, a better approach is to understand where are we in the cycle and position ourselves accordingly. So today, I want to take that one step further. Instead of asking, will interest rates go up or down? Let us ask a more useful question. What conditions are present today that influence where interest rates are likely to go next? To understand this, we need to look slightly beyond Singapore because our interest rates are closely tied to global markets, especially the US. Over time, there is a very consistent pattern in how monetary systems behave. When debt levels become large, governments and central banks face a constraint. They cannot keep interest rates high for long periods because higher interest rates increase debt servicing costs, which put pressure on the system and slow down the economy. So they are often forced to lean toward maintaining liquidity rather than tightening aggressively. Now, let's look at what is already happening today. First, we are seeing long-term interest rate rising relative to short-term rates. This is known as steepening yield curve. What it tells us is that markets are starting to price in longer-term risks like inflation and fiscal pressure. Second, we are seeing the US dollar weakening while assets like gold have strengthened. This usually reflects a shift in confidence where investors are starting to hedge against currency risk over time. Third, while it's not widespread, there are signs of selective diversification away from US treasuries by certain countries. This is not a crisis, not a collapse, just a quiet adjustment that signals how the system is thinking. Now, when you put these conditions together, something important happens. Central banks are no longer operating with full flexibility. They have to make a choice, either keep interest rates high and increase pressure on the system or allow more liquidity and accept a gradual adjustment over time. And based on what we are seeing today, the direction is becoming clearer. The Federal Reserve has already shifted toward maintaining a large balance sheet and markets are expecting rates to gradually ease. Now, this is not about predicting the future perfectly. It's simply observing that when certain conditions align, policy direction becomes more constrained, and that gives us a clearer framework to think about. So what does this mean for us in Singapore? Because our mortgage rates are influenced by global liquidity, if the broader system leans toward maintaining liquidity and gradually easing rates, then the likelihood of sustained high interest rate becomes lower. And this connects directly back to what we discussed earlier. You are not trying to predict the cycle, you are simply recognizing where we are in the cycle and position yourself accordingly. So instead of asking, will interest rate go up or down? A better question today is, are the current conditions supportive enough for me to enter safely? Because when the condition is present, you don't need everything to be perfect. You just need to be positioned correctly. And this is exactly the same idea we discussed before. Good decisions don't come from guessing. They come from identifying necessary conditions and acting when they are present. And this leads to a deeper question. If global uncertainty increases and we start thinking about protecting wealth, where does capital naturally flow to? Not all real estate behaves the same, and not all markets offer the same level of resilience. In the next video, I will walk through how to think about that more clearly. And if you are thinking about upgrading or planning your next move, start by understanding the conditions, not the headlines. No pressure, no rushing, just clarity. I'll see you in the next one. Bye!